Good morning, everyone. I'm Amanda Lang with BNN Bloomberg in Toronto. And on behalf of Bloomberg, I'm delighted to welcome you to this fourth installment of the Bloomberg Canadian Fixed Income Conference series. As many of you know, the Canadian Fixed Income Conference is in its 8th annual iteration. It brings together the biggest names in Canadian credit, bonds, commodities, more political voices. This year, not surprisingly, we've transformed what is a full-day in-person event into a series of virtual sessions, 6 of them in total. And we should note that you can find out about all 6 on the website under Agenda. You can see past sessions there and see about the upcoming sessions as well. Today, it's various parts of the Canadian government that are in focus, and we have incredible voices from across the spectrum of people involved, from finance ministers to mayors to premiers to central bankers. They're offering their insights into the state of the Canadian economy at a national level and also a regional view of the path to recovery. I do want to thank our sponsor, National Bank, which has made this virtual presentation possible for us. So thank you for that. And before we get started, a couple of housekeeping remarks, including if you find that you have any trouble with your audio or video, you can try refreshing your browser, always the first thing to do. If you're still having trouble, there is a tab that you can click on. It's a white tab on the right side of your screen that you can chat with somebody for help. Now, we do want to take your questions as well, as you can see, and you can do that using that white tab as well. Click up on the white tab and you can submit questions there. You can engage with us on social media. The hashtag is hashtag BloombergCFI. And now it gives us a really great pleasure to introduce our first guest, who has agreed to make some introductory remarks that we think will perfectly set up today's sessions. So please join me in welcoming the Lieutenant Governor of the state of New York, Kathy Hochul. Kathy?
Well, thank you, Amanda, and I appreciate the invitation to join you and Bloomberg News, and as well as the National Bank of Canada for your 8th annual Canadian Fixed Income Conference. And first of all, happy Thanksgiving to everyone. I hope everyone's celebrations are going well. A little bit earlier than we do in the U.S., but that's all right. That's all right. And also, it's strange to be not welcoming everyone to New York City. We've all gotten used to these virtual conferences, but just so you know, my heart is with Canada. I actually live in Buffalo. I'm not in New York City right now. I'm in Buffalo, and from my house, I can see Canada. And so I live right near the Peace Bridge. I cross over with great frequency and missed this summer of boating over to Port Colborne and other places, which are usually our destinations as we enjoy the shared border with Great Lakes, Lake Erie in particular, and the Niagara River. And also I do want to mention that the summer was a little more spiced up for us than we expected, as Buffalo became the home to the Toronto Blue Jays. And so I thank Mayor Tory for allowing us to call them the Buffalo Blue Jays for the summer. They had an extraordinary season, and while we couldn't see them in person, it fostered that closer bond that we have through sports and trade and family. I mean, so many people in Western New York, where I live, in the north area of New York State, which borders Quebec, they're not even being able to go to their summer cottages and go see family members. And so it's been a really tough situation for that disconnect, because we're usually so close. And that's a relationship that I've fostered since my days in Congress, where I was very much involved in creating opportunities to have cross-border trade, how important it was to alleviate some of the pressure at the border crossings, which was real detriment to the flow of commerce and the supply chain, which we needed to keep open. You think about industries that are thriving in New York State, Bombardier, building subway trains in New York City, and hydropower from Quebec coming to New York City, which is what we're hoping will be occurring soon. So the synergies are great. And as our economies are intertwined in that sense and are great trading partners, I know Canada trades more with the state of New York than it does with China. And Canada is New York State's largest export destination. So this is a friendship that's been sustained through some tough times, but also both of our economies have been hard hit. So what I want to just talk about for a couple of minutes is of how New York State has been dealing with the pandemic. So there might be some lessons to be learned. And I will tell you right now, I heard from the governor yesterday on our call that our infection rate in the state of New York, once the epicenter of the global pandemic, where we had more cases than anywhere in the world just a few short months ago, we now have the lowest infection rate in the nation. We are at 1.1%. And that's if you factor in our hotspots, which are really concentrated. We call them micro hotspots in specific neighborhoods in Brooklyn and Queens, and those are averaging about 3.7%. So compared to the rest of the nation, our hotspots are still lower than the statewide average in many other states. And, we're not spiking the football here. We're not saying, we're out of the woods yet. We know that we're still vulnerable to the second wave, which I know is hitting some of the parts of Canada. I know there's concern it was starting to be some shutdowns in Quebec starting October 1st. I noted that. And what's happening in Toronto, all this affects us because we are so linked. Our economies are so intertwined here. So what we did was, in order to get that down, we have been adamant, just like Prime Minister Trudeau has worked with Governor Cuomo to ensure that people just do simple things like wearing the masks. Our state was fanatical about mask compliance. The states that are in trouble now are the ones where the governors paid attention, unfortunately, to the president's message that a mask is not that necessary, and they're now paying the price with record hospitalizations at a time when we are seeing those numbers continue to decline. So social distancing, mask wearing, disinfecting. We got New Yorkers, who are really by and large an independent group of people, to adhere to this because of sustained disciplined messaging based on science and data. But the key to all of this is testing. Yesterday, we tested over 100,000 people and the contact tracing. So I know there's talk about whether or not how this is important. If you don't do contact tracing, you don't solve the problem. So that's how we're looking at it. But now I'm also focused on the economy and our comeback, and we're looking to move forward with a Build Back Better strategy. I've covered every corner of the state in the last couple of days talking about workforce development initiatives, investing in people because so many people lost their jobs, and jobs may never come back. As companies are trying to figure out how to right size and make up for lost revenues, there may not be as many hospitality workers coming back, the restaurant workers, people work in hotels and various service industries, and the whole concept of working from home. That may not go back to normal ever again. And so what does that do to real estate in places like Manhattan, which is the bread and butter of our economy for the entire state of New York? So we're focused on figuring out how to rethink telehealth services, teleeducation, teleworking, and are there best practices and lessons that came out of this pandemic where we can actually do things smarter and more efficiently? So we're continuing to build. Our infrastructure projects have not been sidelined. We're focused on that because they're important for the economy, but also keeping people working, which is critically important. So when you look at our economy overall, yes, we have unemployment, but those numbers are continuing to decline. We believe that we'll be one of the first states to become COVID-free because we are so intense on not just the compliance, but also the enforcement. We've gone into over 100,000 establishments to make sure that they're following our rules in terms of social distancing and mask wearing. It's not a position any government likes to be in, but as a result, we're seeing much better outcomes. And so those are some of the lessons quickly from what we've had to experience dealing with the COVID crisis and now have the lowest infection rate in the nation, as I said. So we're going to continue that, looking for more ways to partner with Canada as we rethink our economies and supply chains and making sure that there's opportunities for Canadian businesses as well as American businesses in Canada and New York businesses in particular. So I'm offering that the relationship only grows through this. When you've been in a foxhole together, as we have with a long shared border and a long shared history, that we are going to emerge from this even stronger. And it may sound like pie in the sky, but I know there's a lot of perhaps cynical people or people look at just the numbers. We're looking at the numbers as well. The numbers are driving our recovery. Our recovery is on track, and we'll be one of the first places to emerge from this stronger than before. So I appreciate the opportunity to say hello to everyone. And these are important conversations to continue. Certainly a year ago when you had your 7th annual conference, there's no way you would have figured we'd be having this conversation about how to bring back our economies stronger than ever before. But we are so, as I keep using the word, intertwined. Our economies are linked. Our economies, but also our friendships, our relationships are going to continue to endure through this. And so thank you for letting me say hi, and good luck with the conference.
Thank you so much, Lieutenant Governor Hochul. Wonderful remarks and a perfect introduction, I think, to our first guest of this 4th session, because along with our economies being deeply intertwined, of course, many of our policies, whether we like it or not, are influenced by what happens in the United States. Stephen Poloz is with us now. Stephen was the 9th governor of the Bank of Canada, 2013 to 2020, and among many other things, including overseeing what was and remains a unique period in monetary policy history, became one of the first Western bankers, if not the first, Stephen, you can correct me, but to move to raise rates, to try to get back to normal at a time when Super Mario was still being Super Mario and other bankers were nowhere too close to raising them. So Stephen, I want to begin by thanking you for joining us with your wisdom and expertise. And I guess I want to start with, I'm not going to let you correct me. I'm going to let all that stand out there and say, you, of course, were there and responding to this global pandemic. And as the Lieutenant Governor said, nobody could have forecast that. There is no textbook. Your PhD did not prepare you for this. What do you think is the most important thing you learned, or that the bank learned, policymakers learned through that period?
Yeah, well, thanks, Amanda. It's great to be here. It's a fun day to participate in this conference. Obviously, we haven't written all the chapters of this story yet, but there are some things I guess we learned right away. I would say the first thing, right in the heat of the moment, was that central banks can do quite a lot to avoid financial crises. Most central banks acted very quickly with force. If you compare that back to 2008, it was much faster this time. Back in 2008, it was a little bit more sequential, kind of learning by doing. And so that allowed some of the stresses to build. And this time, I think it was pretty well preempted. And the second thing is that because we started all this close to the lower bound of interest rates, we knew all along that fiscal policy was going to be needed. But we also think of that in a technical way. And when it comes to the actual execution, politics really matters. Fiscal policy was never built for speed, for sure, but politics can keep your car in the shop for a very long time while it gets negotiated or debated or what have you. And so I think the lesson of that is it's better for us to develop more enhanced, stronger, automatic fiscal tools so that they work without the debate. But bottom line for all that is good fiscal policy can avoid the need for negative interest rates, which I think is a good thing for everybody.
Well, let's get to that, because one of the things for sure, whether it was on the monetary side or the fiscal side, and that, this conversation continues, is action was taken. It was necessary. It was, to your point, fast and unquestioned, right? We knew it was an emergency. It had to be addressed. There wasn't a lot of sitting around and hand wringing about any of it. What is in your view, is there a limit to monetary policy? And I want to put that in the context of, you were talking about the need for fiscal policy before March 2020. You were talking about this months and months and months before that. Fiscal needs to step up. So is monetary policy, is there a limit to what it can do?
Well, there is, and we're very close to it. And what we were arguing before the crisis, before COVID came along, was that actually there's a whole second layer to policy discussions, which is the mix between fiscal and monetary policy. If you have a prolonged kind of soft patch for the economy, if fiscal policy does more of the work of giving the economy a lift, it takes some of the burden off monetary policy, and you can therefore have, on average, a higher rate of interest in the economy, which of course cuts off some of those stresses that we pick up, financial strains, bubbles, if you like, too hot of a housing market, those kinds of things. So the mix of policies can matter quite a lot all the time, not just during a crisis. And so I think that was the nature of the discussion there. Of course, it's doubled now, where we have monetary policy basically has done most of what it can deliver. We know there are other tools in the toolkit. Those tools deliver things. We've had experience with negative interest rates, for instance, and lots of QE. But really, all you're doing there is you're trying to squeeze a little more juice out of the lemon. You've done most of what you can do already. And so really, in this stage, fiscal policy is the primary tool. And that's not a new thing. Keynes wrote that in the 1930s, right? It's not some big insight.
I mean, what may be new, and still one could argue an experiment that's unfolding in real time, is this amount of stimulus on the monetary side, 10 plus years of stimulus on the monetary side with fiscal consequences. Fiscal policies have monetary policy consequences. Do you think there will be results here that could be negative in a way that we either haven't foreseen or that we're not prepared for?
Well, I mean, there are some basic things there that we need to keep in mind. First of all, monetary policy looks incredibly aggressive in this situation, but I think that only matches the profound nature of the crater that's in front of us in the economy. So if you're a company, a major company under stress, and you've got credit lines with several important banks, your board was screaming at you in March and April to draw those credit lines, get the cash in the door so that we've got room to maneuver. Well, that influx of cash is like a precautionary demand for credit. And that demand is satisfied usually not through the system, because the system was pretty tight, kind of gummed up, as you know. So central banks are there doing repos and other transactions with banks, in effect providing that credit down through the pipelines. So that extra demand for cash is still there, it's still being satisfied. But as the economy goes back to a more normal setting, that angst will go down and that money will come back through the system. Central bank balance sheets will shrink automatically. So a lot of that has a highly temporary nature to it. The QE, that's another matter. So QE is another matter where you're accumulating that large balance sheet. But in theory, that balance sheet can be any size as long as there is a corresponding element on the other side, government working balances, et cetera. And so the real question we have is sustainability of the fundamental debt that's being drawn down by governments. And that, of course, is something we have to understand better. We could be well over 100% of GDP by the end of next year, according to the IMF this morning. That's what they're monitoring for the major economies. Well, those are big numbers. We're just not experienced with that. And so, provided the interest rates stay low, and it looks like they probably would, it's more of a debt service issue, just like it is with a household. So in the end, I think a sustainability criterion can be met, provided that the government money is being used for productive reasons, productive purposes, and therefore it enhances the ability of the economy to grow through time and to pay off our situation.
But the $64 trillion question for both government and for homeowners is, will interest rates stay low? And obviously, we've experienced very low sustained rates. And unfortunately, you can argue we now have a generation of both politicians and homeowners who know nothing else. They know declining rates, really, as a state of being. They don't know rising rates or rates beyond the bank's control. Every time a journalist raises this question, you get kind of batted down as it's nothing to worry about. It seems to me, given what you just said, that it's something to worry about.
Yes, I think it's something we need to be investing lots of brain power into. And some of the old adages won't go away. But I think that interest rates, in real terms, interest rates are likely to stay low for probably a generation. This is basically a demographic effect. If you look at a 150-year chart on interest rates have been low almost forever, except in the 70s, and the 60s, 70s, and 80s. And that's primarily the demographic boom that we had post-war that drove higher growth rates and higher demand for savings. But if we look, the rest of the time, they've been low. And I expect, because demographics are still slowing throughout the world, interest rates will stay low. But really what matters for debt service is the nominal rate of interest. And that, of course, brings us to what's the outlook for inflation? Because if inflation picks back up, then interest rates are going to pick back up. And so that hinges, of course, on demand and supply in the economy. Right now, we're very preoccupied with deflation risk, and as rightly so. But looking farther down the road, that hinges more on the question of the credibility of central banks, fiscal dominance, if that becomes an important factor, political interference with the inflation process. In addition, we have a number of things that are coming into the system that are more cost push. And so income supports, green taxation, those kinds of moves, deglobalization, those can all add to inflation at this stage of the cycle.
I'm curious whether you're surprised at the relative strength of the Canadian dollar, given everything, not just the debt levels you talk about, the prospects for our energy economy. Does it seem strange to you that we're holding where we're holding?
Not really. I mean, of course, I've always been one to give the market credit for getting it right, rather than to say, "Oh, that's wrong." You know that, but I think if we look out the window and ask, well, what is the whole idea? Think of that crater that has opened up because of COVID-19, and what central banks have done is basically to offset that deflation shock with a major inflation pulse. And so, out we go, and then we're supposed to be able to row our boats across that liquidity, across the crater. And once we get to the other side, then the crater can be drained again. Okay, but for the time being, they're doing the job right, and we can see the evidence in the stock market. We can see it in commodity markets. We can see it in the pickup in demand. So my sense is that the Canadian dollar is reflecting some of that, as of course our other commodity-based currencies. And don't forget, of course, an exchange rate is a relative price. And so when you talk about debt and all this aggression and the policies, well, everybody's doing that. And so does Canada still look like a pretty good place to be and to invest? Yes, it does. And so I think for all those reasons, we shouldn't be that surprised. In fact, when everybody has the shock together, you might expect exchange rates to do some of the buffering. But in fact, they don't do that if the world manages to stay up there and commodities stay firm. That's exactly the same thing, by the way, that happened in the wake of 2008. China took off, and that boosted demand for commodities, and so the Canadian dollar actually went up in that time period.
I am curious for your view of the Canadian housing market. And I guess feel free to kind of extend that back into your term. We've been worried about household indebtedness, about an asset price bubble. And various policy levers have been used to try to kind of rein it in. Today, as we sit here watching this extraordinary in those hot markets, not everywhere, but in those hot markets, strength and asset price moves, are you worried about housing?
Well, not really. I mean, I think if we get back to the nature of the recovery, by the way, I think the K shape is probably the best descriptor I've heard. I don't even know who made that one up, but I saw Joe Biden use it, so it must be a good characterization, and it's being widely used. But the top part of the K has recovered well, as you know. Basically, that pertains to around 95% or a little more of the economy. The bottom part is where the damage is the greatest. It's around 5% or less of the economy. Of course, the airlines, retail, hospitality, business, tourism, that kind of thing. So we can have a long-term unemployment issue in those sectors, and eventually a supply side damage, right? So supply side damage. But along the way, that other 95% is what matters to how the economy will behave. And with interest rates at generational lows, you're bound to see a certain amount of heat in the housing market. We have months of pent-up demand coming through there. And of course, we're seeing the results of that combined with low interest rates now. We're supporting incomes so that it's not like people are doing it on a wing and a prayer. Even though the economy went down, income was supported. And so the real question is it sustainable on a debt side? And I've always argued that it probably was. Of course, that doesn't mean that the prudential policies shouldn't be continued, and to make sure we keep that in check. But I think we have just as good a chance of growing out of this as we have on the fiscal side.
We do have a question from the audience that I want to bring in, because we are, of course, just a few weeks away from a U.S. election, and that may have an influence on what happens here in Canada, of course. Do you have a view of a Biden versus Trump presidency and how that affects recovery? And does anything worry you about U.S. politics right now? That last one's too big to answer in full, but give us the highlights.
That last one is too big to answer at all. But anyway, if uncertainty is an important driver for economic decision making, as it is through most business community, The uncertainty has never been quite this high. But I guess from that point of view, at least in a few weeks, that uncertainty should go down. Whichever direction it takes is an important question. But the main thing is that uncertainty can go down. But I think that between the economic policies that I've seen between Biden and Trump, they don't look like night and day difference. Okay, so there's a certain amount of trade policy would be perhaps calmer, more predictable, perhaps, but similar kind of intense. Regulatory policies, not too different. Maybe a little more emphasis on climate. That's a good shift that could happen if it were Biden. But apart from that, I'm not seeing a huge difference in how the economy would behave. I think the economy is actually recovering better than most people thought, as is the Canadian economy. And that's precisely because policies have been excellent. And because one of the things, Amanda, that I'm going to go back a few years. You remember after 9/11, people said, economists said, oh, people will never travel again. Yep. They said that, and they said, therefore, we're going to have slow growth for a long time, And they never asked the simple question, I wonder what people will do with the money that they don't spend on travel. And so you ask yourself, what are people doing with the money today now that they're not eating out, now that they're not taking that trip and all that sort of thing? Well, it's pretty clear they're doing the same thing they did back after 9/11. They're spending it on their home or buying a new place or what have you. So that's where the action is. And I guess it's possible there'll be long-term effects on, say, flight attendants or in restaurant workers. And those folks may need to eventually transition into doing renovations for your kitchen, because that's where the job growth is going to be for a while.
So, I mean, some of that kind of natural evolution, I think, will be upon us. I do want to talk about that when we talk about the K-shape. I mean, one thing that is distinct about this event is that the degree to which it hurt people was uneven, and the degree to which people are recovering will be uneven. And that happens on the overlay of the inequity we already saw. And it was an inequity that you played a part in, which was the savers versus the borrowers. Savers have been getting the short end of the stick for a good 10, 11 years here. That's not likely to change. And so that inequity is really only amplified. Should it be of more concern to us now? And are some of the policies we're seeing post-pandemic actually helping to address that?
Well, I think income distribution is a really important determinant of how the economy behaves. And therefore, it's a critical overlay to how we make these kinds of decisions. But I think of it as an overlay as opposed to a primary driver, and I'll tell you why. The reason is that, say we face a really bad patch in the economy. Well, the only tool we had was either cut interest rates or do fiscal policy, or hopefully both. Well, of course, when we cut interest rates, we're told, well, you're adding to inequality. Well, I think the most important driver of inequality is the economic cycle. And so if the economy is weak, it's the lower end of the income spectrum that gets hurt the most. And so if you're able to use your tools in order to mitigate that and bring up the economy so that those people are hurt less than they otherwise would be, then you've done the first layer of mitigation that you can do on income distribution. If the tool has a side effect, which people don't like, well, okay, but the primary is most important. If the surgeon says you need surgery to save your life, well, okay, but won't it hurt? Well, yes, it will, but that's a side effect. The main thing is we get the job done. So I think people lose sight a bit of that primary directive, which is there in order to stabilize the economy, and that is an important driver of this redistribution issue. Well, there's no question you're onto something, and the longer it goes on, the more important it will become, and therefore the more it becomes very important that the fiscal action that we take has that as part of its objective. And naturally, the things that have been done so far do. And so I think a lot is being done on that front. The outcome remains to be seen. We won't really know for probably a year or more how we turn out.
We have a question from the audience that fits in with this because it goes to the generational question of imbalance and inequity, and what sort of efforts and policies should governments and central banks use to promote wealth generation for the millennial generation, which lags the boomers. Other than, the boomers will die and pass on an awful lot of money. Should there be more thought given to this generation, which really is getting certainly certain cohorts of it are really getting short shift here?
I agree. And I think, well, as I said earlier, I think the most important criterion for governments is to ensure that the money that's going out the door is somehow contributing to the growth prospects of the economy, not just stabilizing the economy, but the long trend and growth. And that is productive infrastructure. And in there, I would include social infrastructure. And so, for instance, daycare, which sounds like, oh, that's really expensive. Well, that would be really expensive. Well, no, that's the kind of social infrastructure that can pay for itself. Because if you look at Quebec, how much they boosted labor force participation by women by having a very up-to-date kind of daycare system, whereas the rest of Canada has lagged that. And I think having those kinds of smarts about the policies will add a lot to your question about redistribution of income, stabilizing that, as well as adding to the growth trend of the economy long term. And that's how we will pay for all this.
I want to ask you, I think the surgery one is an apt one. Having said that, of course, surgeries can go too far. They can be overly aggressive. And with hindsight, you say, we might have only taken off the finger and not the whole arm. So just in terms of what you've seen, and then I'm going to ask you actually to take it back to your whole term, because we haven't talked since you left. But is there something you wish hadn't been done from a policy point of view, or that you would do differently with hindsight?
Not really at this stage, Amanda. I mean, I think, as I said earlier, I think the real lessons will have to be drawn when the episode's really over. At this stage, you might have thought it was overreaction on some fronts 3 months ago, but now that was back when we thought this might be over in 6 months. Now it's been 6 months and it's clearly not over. And so I think those kinds of judgments really can't be reached when we're still in the middle of it. So I think everything that we've done so far was essential, and maybe some things could have been done faster. It might have made a difference. As I said, politics kind of gets a little bit in the way, and if we had more automaticity to those fiscal drivers, that would have been a handy thing to be able to rely on. But that's about all I've got for today.
We are, of course, not out of the woods yet. We don't even see the daylight on the other side, where in terms of the path of the pandemic, lots of talk about resisting negative rates in this country, at least from a central bank policy point of view. What's your thought on that? Should we fall deep back into a pandemic with nowhere else to go? Is that where we go?
Well, it's not right for me to comment on actual issues that are under consideration or being analyzed at central banks today. But I mean, I think what we've learned about negative interest rates so far is that they've really only been deployed in cases where fiscal policy was failing to provide the solution. So in Europe in particular. And so in Europe, of course, they've made a big move there now. So we're going to have a bit of a fiscal reaction, or part of the policy toolkit. That's a big improvement, and that I think is going to be more effective than negative interest rates ever could be. But in theory, they all remain in the toolkit. And as I said before, there's a little extra juice in that lemon. You want all the juice you can get. If you're the last person standing, you've got to be doing your utmost. You can't say 2 years from now, well, I did everything well except try those negative interest rates. You've got to be able to say I did everything. And so I think that's kind of where I see it in theory. How central banks sort all that out, that's of course somebody else's job these days.
Well, we have had a pretty big discussion here, Stephen. Thank you very much for being part of this conversation and this conference today. It's great to have your wisdom at this time. Thank you.
Always a pleasure, Amanda. Take care.
Breaking news from Sydney. A total clampdown on Bitcoin trading is sending a flutter through global markets.
In Beijing, Bitcoin prices are taking investors on a wild ride.
And here at home, the volatility in cryptocurrency for Canadians may just be the tip of the iceberg.
Understand the world impact on the Canadian economy as BNN, Canada's business news network, joins forces with Bloomberg, the leader in global finance. The all-new BNN Bloomberg. Local insights, global power.
Minister Girard, welcome again to the conference. In a few seconds, we're going to talk about our topics. I hope I will be hearing you. We've had some technical issues before starting, so let's hope for the best. Everything was going so well for Quebec when COVID hit. You were on track with a good fiscal results for the past 2 years. Your overarching goal was to bridge the gap, the wealth gap with Ontario, and then suddenly Quebec became the most hit province during COVID. A few months ago, you gave us some idea of what the year was going to look like from a budget perspective. You said, we would have a budget deficit of $14.9 billion, and you predicted that the growth contraction would be about 6.5%. Now we're in a second wave with new measures that are being implemented. Can you give us an update, a little bit of where the Quebec economy is going? Are you still around that 6.5% contraction?
Yes. So we in June we a portrait or an update, and we forecasted the 6.5% decline for GDP and a $15 billion Canadian dollar deficit, which amounts to 3.5% of GDP. These numbers are still broadly in line. We will come up with a fall update sometimes later in the fall. The date is not announced yet, but these numbers are still ballpark in the right area code or zip code, as American would say. These numbers are still reflecting the current situation.
And you had set aside about $4 billion for, a second wave, which we're now seeing. Is that also, do you think that's going to be the ballpark also for that?
Yes. So this we've already used $2 billion, and that's public for municipalities and public transit, and it's very important. These municipalities are an area of government that is very close to citizen, and they do make a difference. And so this $2 billion is funded half by the federal government and half by us, and it will make a difference. And I'd like to come back to your initial statement or initial question. It's perfectly true that in the beginning, we entered this crisis from a position of strength. We just came from 3 years of above trend growth, full employment, 2 years in a row outperforming the rest of Canada, and our public finance were in excellent position. So this is helping us weathering the storm and making a difference for our citizen and our corporation.
So you have a plan to go back to a balanced budget, and you've said within 5 years. I just want to see, with this second wave, you're doing the best you can to help companies, but some are going to drop out of the game. We're going to see some closures. We've seen some closures. Do you think that within that context, you're going to have sufficient enough growth to sort of get the tax receipts and bring that budget in balance within 5 years?
Yeah, there's a lot in your question, and the first of all, so we closed 40% of the economy in March and April, and then we reopened in May, and the reopening phase went really well. Our unemployment rate is we've recuperated 95% of the job level that we had in February. And so this phase of what we call the period following the confinement, I don't know if deconfinement is the right word, but this phase went really well. Now what happened is we had a good summer, and we had a number of cases that was around 25 per million around August 25th. And suddenly, very quickly in September, the number of cases started doubling every 14 days. So we went to 50 per million, 100 per million. And when we were early October, around 125 per million, we decided to ask citizens to reduce social contacts and come with very limited closing of businesses where people were gathering in order to stop this increase every 14 days. And so far, so good. There's still a lot of work to do. We've asked citizens to do extra effort until October 28th. But we had to act in order to stop this doubling of cases, which was going really fast. So with respect to the 5-year plan, it's very important to have a credible plan that is transparent and that will be understood by everybody. So our role is to show the path toward equilibrium. And so 2020 is a year of minus 6.5%. 2021, there will be a bounce. But starting 2022, 23, 24, 26, we need to go back to increasing the potential of the economy. And so through increased growth, what we were doing prior to the crisis, catching up the lost growth of 2020, 2021. More growth. We also are asking the federal government for more healthcare transfer. It's very important. And finally, by aligning expenses with revenue growth is going to be in the neighborhood of 4%. If we maintain 3.5% expense growth, we will be able to come back to equilibrium within 5 years.
And just for our public, equilibrium in Quebec understanding means after the payments to the Generations Fund, right?
Exactly. So it means that we would have started reducing our debt level again.
So just to go back to the Generations Fund, it's interesting because at the time of the budget, you were already starting some reflection on, the pace of debt reduction. Of course, you had hit the target early. Now we're in a completely different situation. And you've mentioned that you actually would like to, maybe you will have no choice but to rethink the debt path. What can you tell us about your reflection on the Generations Fund and on the debt target reduction, the pace?
Okay, well, the Generation Fund is here to stay. And what I've said is it's important to remind everybody that from an accounting point of view, budget balance is before a contribution to the Generation Fund. And according to the deficit reduction or the debt management law that we have in Quebec, we are reporting after contributing to the Generation Fund. But that doesn't change accounting standard. Accounting standards or public account standard would be before contributing to the Generation Fund. So the Generation Fund is here to stay. It's an important aspect of our debt reduction plan. We used to be the province that was the most indebted. We are now slightly better than Ontario, better than Newfoundland, and we want to keep improving. And it's really important from a generation point of view. Reducing debt is helping us planning for the long term. It's going to help us fight climate change, ensure public services in education and healthcare. And it's really about long-term equity for future generation. So we intend to resume reducing debt following the difficult period that we're all facing.
Starting when then? How does that change your plan, which was calling for a number by 2026? I believe 45% of GDP.
Yeah, well, with what's going to happen today, we've said in June that we will hit a gross debt level around 50% of GDP on March 31st, 2021. So from there, we need to first reach equilibrium. and then we will reduce debt again. So what I've said is that we had set a goal of 43% in 2025-26, and I've been really transparent and honest. It's going to be difficult to reach that 43% in 2025-26. So in the next budget, when we give the 5-year plan, we will show where we are and what we can do in terms of achieving new targets.
And is there any chance, when you came to power early on, you used some of the Generations Fund money to sort of buy back some debt? Are you planning to do anything with the fund to sort of take advantage of interest rates? Is there any plan like this in the works?
At this point, no. But we have an excellent debt management team. We're always looking at options, but the cost benefit of paying down debt when our average funding cost is around 1.5% is less solid. So at this point, no.
So you were talking about towns earlier, and the help you're giving. We know Montreal has been asking. The mayor was speaking just recently, asking for more help for the city center. Are you planning to do more to start with, and otherwise? And what's the risk for your public finance? I mean, everything's going to start adding up.
Yeah, well, everything that we do, we always do it with efficiency in mind, because we have long-term goals to increase the potential GDP, to have our corporation to be more productive, to increase the labor supply. So we try to do our short-term intervention. We try our short-term intervention to be coherent with our long-term goal of increasing productivity and potential GDP. So we always keep that in mind. We live a pandemic, an economic crisis, and therefore we need to be there for our citizen and our corporation. So yes, it's quite possible that we need to do more. The federal government just announced last Friday that they're going to be doing more. We are talking to them. We're in constant communication with the federal government. It's really what we have to do. There's a crisis, and we need to support people.
But do you think? I mean, one of the options that was presented in a report from Montreal a few months ago was to let the city sell some bonds, for instance, to finance its deficit. Something that it cannot do at the moment. Is that something you're considering?
Well, I think these options were being circulated before we announced the $2.3 billion support for municipalities and public transit. So I'll let them manage their public finance and do their announcement. But the support that we've announced, obviously, there's very important sums for Montreal in there.
Okay, so it's not something on your radar in terms of changing the rules?
Well, they would have to make an official request for this, and it would go through the Ministry of Municipal Affairs. But again, these talks were preceding our announcement for $2.3 billion aid.
And speaking of Montreal, so I was looking recently at the number of new condos that are being listed on the island, and there's been a surprising increase, especially after the past few months or even years, of a decreasing lease and a very, very tight market. Obviously, one of the movements behind that is the very weak immigration compared with past standards. Can you give us a little update on how your government views immigration? Because at some point there were questions about, having tighter quotas to make sure everybody in Quebec finds a job. Where do we stand on that?
Well, first of all, I do want to say what everybody knows is that immigration has a very important contribution to the Quebec society and the economy. So we're very much in favor of immigration. We have a particular situation where our common language is French, and we're 8.5 million people in a sea of 500 million people. And therefore, we want to improve integration, and we want to be able to make sure that newcomers integrate into society and have the opportunity. Basically, we want to take the French course to them rather than wait for them to go and spend some very important time for them learning French. So what we did is we went from 52,000 immigrants per year to 40 the first year, but already we are in the process of increasing to 44, 48, and going back to 52. So we had an adjustment to make in order to help people integrate with the society. That's already in the process, and immigration will be a very good contributor for future years for Quebec.
Are you keeping an eye on this phenomenon I was mentioning of, a very fast increase in condo listing? I mean, is there anything on the Montreal, in particular, real estate market that is of concern to you?
Well, what's a concern to me is the number one concern is the pandemic. We need a sanitary situation or a health situation that improves to help the economy. The second thing is we are facing a world recession. And right now, there's a lot of activity in real estate overall, and house prices are going up, and demand is strong, and we're seeing this all over the province. And yes, there is a supply of condo in Montreal, but I would say with respect to real estate, we're going to need more time to really assess what's happening in this market. Because the market, when you look at the aggregate numbers, appears to be way too strong for the fundamental. But you're only looking at current data while we were closed in March and April and part of May. So I think with respect to real estate, the best thing to do is let some time go by and analyze the data with respect to what happened during the period when we were closed, what happened after, where are we? The real estate market is not a market that we should look at like Google activity index.
Minister, you said, you must be talking to companies all the time, and including in your district. There's a lot of discouragement and fears and concerns from restaurant owners and other companies that had to close again. I know you've given them some support, announced some support, but I mean, how are they? How are you going to do to avoid so many closures coming up and to help close that gap? I'm going back to my first question on how you can go back to sort of pre-pandemic growth level by 2022.
I think when you look at a small business, their two main fixed costs is rent and HR, and we've addressed both. The federal government is subsidizing 75% of the payroll, and for the employees that have been temporarily laid off, there is some support with the CERB and the unemployment insurance. And with respect to rent, we were subsidizing up to 75% of rent, and this program expired at the end of September, and now following many discussions with the federal government, there's going to be a new program that will account fixed costs. So if you assume rent and HR costs, or a significant portion of rent and HR costs for these businesses, most of these businesses will make it through. And also some of these businesses are still operating and selling through takeouts, and the summer was decent for many of them. So it's a very difficult period. It's difficult for everybody, but the supporting fixed costs is helping them being on pause, and will help us ensure that they will be there when we come through more normal times.
You mentioned the federal government several times. How much have you gotten total from the federal government so far?
Well, we are 23% of the population of Canada and 20% of the economy. So once the federal government release their total numbers, we will be 1/5 of these numbers, except for the revenue decline. But if you assume that the salary subsidies and the income support for individual is going to total close to $200 billion, we would be anywhere between 20 to 25% of this.
And you've been pretty positive, I think, about all the measures the government have taken, the federal government.
Again, we're living through a pandemic, to the worst global recession since the Second World War. We need to help, and these programs have been helpful. It has allowed us to concentrate on what is the number one responsibilities of a province, which is healthcare. Healthcare is a provincial responsibilities. This is the heart of the crisis. We're spending. We're going to have increase in healthcare costs this year that are going to exceed 10%. We're going to spend many $billions more for fighting the pandemic. And so while we concentrate on this, and we're also supporting our people and our businesses, but the macro support that the federal government has provided for individual and businesses is welcome.
All right, well, I think our time is up, Minister. Thank you so much for taking the time.
Thank you very much, and I hope to be in person next year.
Me too.
Thank you very much.
Reporting from Silicon Valley with breaking news of a major development in the field of virtual reality.
Here in Hong Kong, reaction has been swift, with the VR sector exploding in recent years.
In Toronto, tech stocks are surging. Let's take a closer look at how this will affect Canadian investors.
Understand the world impact on the Canadian economy as BNN, Canada's business news network, joins forces with Bloomberg, the leader in global finance. The all-new BNN Bloomberg. Local insights, global power.
Thank you very much, Sandrine, for that. I'm Danielle Bokov, and it's a pleasure to be here today, and a pleasure also to introduce Mayor John Tory to our audience today. Mayor Tory, thank you very much for joining us.
It's my pleasure, Danielle. Thank you.
The pandemic obviously is creating a vast range of challenges for all levels of government. But unlike the provincial and federal government, city governments in Canada have to balance their budgets. So I'd like to start with your views on that difference as the mayor of Canada's largest city, which is, of course, Toronto. Is it okay to have two sets of rules in your mind?
Not only is it okay, I find it to be a desirable state of affairs in which to operate. I mean, the requirement to have a balanced budget puts a discipline on us that I have found in my 6 years of this job very helpful, in that when we get to the end of the process, you have to make some choices. You don't have the choice to kind of postpone, in effect, the decision as to where you get the money from off into the future. And some of the choices are very hard. Now, I will say to you that the real problem isn't, it was even proposed in the last few months by the provincial government that the requirement to balance your budget be waived for at least the period of the pandemic. And I strongly opposed that. And I said, no, in fact, what we should be addressing is the reality that cities, including the biggest city in the country, are responsible in many cases, if not most, for the delivery of a lot of the help that goes to people and to businesses, number one. Number two, those very same cities do not have the financial capacity to raise the money necessary to finance some of those kinds of activities. They were never intended to finance social programs, for example, because they relied on property taxes only, which were meant to kind of finance, in effect, hard services. And thirdly, the whole fiscal arrangement framework as between the other governments and the big cities in Canada are based on an 1867 construct. So today what you have is the city of Toronto with 3 million people, upwards of 20% of the GDP of the entire country, with less financial capacity to do things on its own and be accountable, by the way, to the voters for it, than the province of Prince Edward Island with 156,000 people. And I have nothing against PEI. It's the cradle of Confederation. It's a lovely place. I've visited many times. But, 156,000 people is less than a quarter of the population of Scarborough, which is the easternmost part of Toronto. For those who don't know Toronto geography, it's ridiculous. It's out of date. It's archaic. It is unrealistic, and it needs to be changed. But who wants to open up the Constitution? Not me. But maybe we should just come to some better arrangement that will reflect the reality without taking away the discipline of balancing the budgets, which I think most mayors would say, no, it's tough sometimes and it causes you to have to sort of have agonizing meetings, but it's a good thing.
Well, and in fact, I mean, would you be in favor of some sort of a mechanism that would make the same rules apply at a provincial and federal level? I want to talk about sort of ways that the cities can raise revenue, but I would like to get your view on the fact that it's a different system at different levels of government. That's okay with you?
I would not start off instantly opposed. As long as you made a distinction between capital investments you're making and operating expenditures, I wouldn't start off being opposed to a measure like that being imposed on the other governments, because what tends to happen that is the greatest evil in my view, and I'm a nonpartisan now as mayor, but is that you end up borrowing to finance operating expenditures. And I will accept the period of the pandemic, because obviously those are extraordinary expenditures that are designed just to keep us afloat, and I support those, and we can talk about that, I'm sure, later. But I do think that some greater sense of discipline that just stops you from piling debt on out of operating expenditures is really no different than what you do in business. I mean, I ran a big business for a period of time, and as much as my boss, Ted Rogers, was a person who certainly believed, to say the least, in acquiring things and in making capital expenditures, I was very conscious of the fact that we wanted to make sure that we didn't start borrowing to finance our operating expenditures, because, that was something that was would have been wrong. And I believe it's wrong for government. So if you said to me there were to be some other disciplinary or constraint measures on governments to stop them from doing some of the kind of borrowing non-pandemic related, I would say I'd certainly, not rule it out, depending on the mechanism. It has to work and it has to be realistic, but, I wouldn't rule it out.
All right, well, let's talk about your pocketbook, for lack of a better word, I guess. Some of the poorest, as you've referenced already, have been affected the most by the pandemic. And I was really interested to see that Toronto issued a social bond right in the middle of the pandemic, $100 million, very low borrowing costs to support social and affordable housing. Tell us where that idea came from. Is it something that you think you're going to be using again?
Oh, definitely. And what we had to do was to make sure the marketplace, both marketplace for a social bond from a big city in particular in Canada, but also the marketplace in a pandemic time was, receptive to this issue. And we found it was receptive, more than once over. I mean, in other words, we could have sold more. And in fact, when you mentioned a low borrowing cost, it was the lowest borrowing cost we've ever had. And what I was particularly gratified by is that the market, and I'm not surprised at this because we weren't the first people in the world to issue a social bond, but I was surprised at the degree to which there was a very acute understanding, more so than would exist probably even with some people in city government and certainly with the taxpayers, of what the difference was, that this was going to finance, as you said, things like affordable housing and some of those kinds of measures that are so important for us to get on top of. What's great is that oftentimes what you've got is those kinds of socially related investments competing with public transit, which I also view in part as a social program, but competing with much harder, things that we finance with our debt instruments. And this proved that things that I'll call slightly softer and that relate to the social side of our responsibilities met with a very strong response from the marketplace. And I always say this because I'm the mayor, not the person that's out there trying to get these issues to be done successfully, that, I always will ask them the question with a smile on my face, well, why didn't we make the issue twice as big when the response is so good? But I think it's also a reflection of question number one, too, which is the city is seen as being well managed, and I intend to keep it that way. We have acceptable levels of debt, and we operate each year on a well managed, prudent basis. So I think that's a reflection of that as well.
It's nice to know, though, that the demand is clearly there. If you need to go back to tap the market again, will you? Do you think, is that going to be sort of your first line now going forward, depending how bad things get? Because obviously, last week the picture on the pandemic in Canada is not looking great, but particularly not in Toronto right now.
I think the answer is definitely yes, and I'll add green bonds to that as well, because we've had several green bond issues, I think totaling maybe $600 million. And again, there's a great desire for it in the marketplace, a great appetite. And I think it's a way in which the fixed income business, we're talking to people in that business, can help us play a significant role in, building up a great city and building up a livable city and addressing climate change and addressing some of these social issues, which, as you point out, have been made worse. We had them before, but the affordable housing issue, to pick one, has been made worse in some respects by the pandemic. And so the answer to this question is yes. If it's an instrument that works, if there's a market for it in the marketplace, if we can get low borrowing costs and there's a significant demand, why wouldn't we be going back? So I leave it to the experts to decide sort of when and how much, even though I ask them every time, why didn't we do twice as much when they're well received? I'm quite sure the answer is yes, we'll be going back into the market within our debt limits for each year. So probably in, maybe something, there's not much left to be done for 2020, but certainly in 2021, I would expect we would be on both green and social bonds. And thank you to those who are out there who help us make those a success, because I know it's not just how well managed the city is and all that, and great affection for Toronto, which I know is held across the country in depth, but it's also the skill of the people that we retain to help us to sell those instruments.
So let's talk about some of the other tools at your disposal. Obviously, they are much smaller than the social program requirements that you are facing. Other big cities like New York have sales taxes, they have income taxes, we have property taxes. I think it would be difficult to raise them significantly probably in this environment, given how stretched people are, as you've said. What other tools do you need to get the money you need to fund the social programs that you need?
Well, I think something that I've talked about before years ago, going back before I was mayor as head of civic action and so on, is the possibility, for example, of some kind of a regional, levy of some kind that could be used for some of these purposes. But, I'd be content with some arrangement that didn't have us going on an ad hoc basis. It seems, especially in pandemic times, it seems every few weeks, to sort of ask the other governments for money and then never be entirely sure, because they have their own dealings with each other, which are complicated in our country and its arrangements, that never have us really know who's doing what for who. And I should say, by the way, that especially the federal government, but so too has the provincial government, been very responsive to a lot of the requests we've made, including most recently requests we made on behalf of small business and restaurants and so on. But it's very complicated, because we're going up there as the people who in most cases are actually on the ground, responsible for delivering in whole or in part a lot of these services, because we're on the ground closest to the people, a lot of these kinds of programs. And we have to sort of go and ask, and then they have their own dance with each other and we have a dance with them, and on it goes, as opposed to if they said, fine, we're not going to let you increase taxes going forward or create new taxes for you to levy, as is the case in New York, like you said, but rather we're going to give you some kind of a guarantee that you actually can rely upon in your own planning as to the kind of support that you're going to get for some of these things that need to be done, and that you, in fact, are the ones that need to do. The province of Ontario gave us, in the City of Toronto Act, which people in other provinces will have probably heard of because they have similar discussions going on, the power to levy other taxes, like, for example, a tax on a bottle of alcohol. And so when I went to the province and said, okay, we might do that to help us raise money for transit or social housing or whatever, and they said, oh, gosh, I know we gave you that power, but we really can't have two different pricing regimes and really don't want you involved in that. And how would you collect it? And I said, well, I had it in mind you'd collect it at the liquor store when people bought a bottle. And they said, oh, no, we can't be doing that. So, they render these very things we were given a number of years ago completely, null and void. And we just can't go on that way. It's an 1867 regime. I'm running with my council colleagues a city of 3 million people. It's bigger than, I think, all but 4 of the other governments in the country. We have significant responsibilities, and we can't be left in a position where we either raise taxes beyond the point where they should be, or where we have to go cap in hand all the time.
Can you put those responsibilities into context for our viewers? Because a lot of them are outside of Canada, right? So you've talked about the fact that social programs are under stress because of the pandemic, that the marginalized are being hit harder. How much of an impact is that going to have on your budget?
Well, public transit, for example, is our responsibility. We receive funding for the capital expansion side of it, but none on the operating side. So it means when we lose, and this may not sound big depending on what city people are sitting in, but for our city, when we lose 2/3, actually 80% of our ridership, and thus start losing $25 million a week on transit revenue when we have no chance of recovering it, That is all money that is, because the public transit organization loses money, if I can put it that way. It needs to be subsidized as to begin with. So if the fare box evaporates, then you're left with that. Housing, uniquely in this province of Ontario in Canada, the city is totally responsible for social housing. And so we have to come up with the money to not only operate that social housing, which are for some of our most vulnerable residents, so we can't just raise rent, but we also have to finance the capital expenditures. And again, we get a tiny bit of assistance with that. And then on top of all that, we have to make sure, the water turns on safely, that the sewage is taken away, that the waste is picked up, that the parks are in order, the transit system runs, the roads are repaired, the housing I mentioned we have to finance. I mean, it goes on and on. And we have all these responsibilities, because that's the other alternative, I suppose, Danielle, that exists, which is if they want to take responsibilities away from us and upload, as we call it, take back housing, I would say, okay, that would be fine. We'd talk about that, and that would save us a huge amount of money, which we could then apply to other things. But that's not the case. We keep getting things downloaded on us because we actually run them fairly efficiently, and we don't have the revenue sources to pay for them, and they will tell us that they're in tough times and can't give us any money. So how does that work?
Let's talk a little bit, that's your problem to solve. Let's talk a little bit about how we get out of this. Now, I know over the summer, Bloomberg reported that you had gone to a number of Toronto businesses, including some of the big banks, to ask them to extend their stay-at-home regimes for their employees until September. September has come and gone. Have you gone back to business with any other requests?
Well, actually, my first and only request originally was that they simply scale or spread out the return to work so that people didn't come back all on the same day, say the day after September 1st, and overwhelm the transit system and overwhelm the elevator capacity of the big towers downtown and all that. Some of them took that to be a request to have people not come back because I think, quite frankly, their own purposes were suited. And they were surveying their employees and finding their employees were nervous about their kids going back to school and whether that would last. And secondly, were nervous about using the public transit system, which I'm sure has been faced in other cities. In fact, I know it has because I've been on some of those international chit-chats. And so I asked them in September, when I did get together with them again, if they would, make sure that they were actually staging the return to work of the employees, only because it was not ultimately going to be healthy for the downtown or the whole city to have nobody at work. They're presently running at about less than 15% of the towers being occupied. They told me, to be candid, because I've mentioned this publicly, that they would be lucky to be even close to 50% by Christmas. So that is much slower than I would like to see, because we, I think, can handle the public transit of that kind of, getting to 50%, say, by Christmas. It's certainly what's happening is a lot of the businesses downtown that rely on that daily downtown life are starving. And while the governments have come forward with some very helpful programs for them, I would like to see the downtown coming back to life on a sort of more staged, gradual basis, but moving just a little bit faster than it is at the present time. But that's out of my control.
And yet the numbers have been getting worse, though, right, for the virus. Like we moved the opposite direction last week with Premier Doug Ford closing restaurants in Toronto, for example, for indoor dining. So is it realistic to expect that things will move faster now? It seems to me they're moving slower.
Well, they are moving slower, and I guess I had wanted them to move faster than what was happening, which was nothing was really happening by way of people coming back. And I agree, as the numbers move around, obviously 4 or 6 weeks ago, it would have been less complicated to have a staged return to work going on throughout the fall months. Now it is more complicated. But I think if you look at the measures that have been taken by the landlords, because I've had conference calls with them too, and you look at the measures that have been taken on the public transit system and so on, and if you look at the fact that the provincial government here said restaurants and bars would be closed, but specifically said people could go out to work, I think that we have satisfied ourselves that while you can never take the risk to zero, you certainly could have people return to work in slightly greater numbers. I'm not suggesting people should stampede back to work all at once between now and Christmas, not at all. I'm simply saying that from somewhere between 15 and what they said to me was maybe up to 50 by the end of Christmas. There's some other number that could be more gradually implemented and would help us to restore and keep the health of downtown. But it's a balancing act. So I understand completely that your question was an extremely valid question. We grapple with it every day, and they have to make decisions, meaning the companies, as to what's best for them and for their employees. And I strongly support that.
And as you say, the impact is devastating on a lot of the downtown businesses. It's hard not in that context to worry about commercial real estate. We're in month 8 now of this. People are getting used to working from home. How worried are you about that excess capacity lingering for long periods after the virus is gone, or even never recovering?
Well, it's my job to worry about that, but it's also my job to come up with an answer, not just sit here and wring my hands and say everything's going to be doom and gloom. I am actually a huge optimist about Toronto, and I will say this in the presence of people from other cities in the world. I like our chances of attracting smart people and smart investment after the pandemic is over relative to many other cities in the world, partly because of how we've come through this so far. And I'm not popping any champagne corks, but I think we've done well. We've seen, had the world see that we can cooperate with other governments, we can work together, we can rely on the advice of experts, and we are still the same attractive place to come with all the smart people and the well-established financial services core and the well-established life sciences, a huge and growing tech industry, I think the third biggest in all of North America. So I'm optimistic the right bones are here. And I just heard a report this morning that would, on the one hand, strike fear into your heart, which is they said 40% of people may never go back to work in the same old office environment. And we're a city full of office skyscrapers. But at the same time, they said, well, those people will be able to work from anywhere in the world. So they can work from any city and do work that is done, in effect, in Toronto. I like our chances that people are going to pick this city to live in because of its quality of life, because of its values, because of its sound government. And they will work in Brussels, or they'll work in Hong Kong, or they'll work in Rio de Janeiro, but they will live here. And I'm very happy about that. And that will, I think, in turn, provide some answer to the office space dilemma, because those people will need a place to work. They won't want to sit in a condo all day doing that necessarily. So we're going to look at this very carefully, because there are acute potential problems arising out of all this. But I am not going to sit here. I'm saying I'm worried about it, which is honest. I am not going to be saying I'm, sort of throwing up my hands and lighting my hair on fire, because I think there's an answer that will take advantage of the competitive advantages of Canada and of Toronto in particular as the biggest financial center and the biggest city in the country.
And where does commercial or residential real estate fit into that? Because obviously there have been some signs of softness in the condo market, a little bit of flight to suburbs in some cases, because of the work from home regime. What are your views on that softness in the condo market in Toronto, especially if people, as you say, are going to be doing work in Canada from Brussels?
Well, but so too, I hope, will people be doing work in Toronto and Canada in Brussels from Toronto. And so I look at it this way. I believe that once the borders are open and the pandemic has subsided, the immigration to Toronto, which was totaling 100,000 people a year, just to Toronto, 100,000 people a year were coming to the city, and they were among the best and the brightest from all over the world. That will pick up again. And that was a big part of what was driving the housing market. And it will have to drive the housing market again, because when 100,000 people come here, no matter how many people move to the suburbs, they need a place to live. And people wanted to invest in Toronto real estate. I think they still do. That's evidenced by the fact that there are still lots of projects ongoing. There are still as many cranes in the sky here. I know there may be some interruption to that. Who knows? I mean, I'm not an expert on that, but we'll be trying to sort of say to people, look, this city's good bones will be still there when the pandemic is over, and the immigration will pick up again. There are many people in the world, thank goodness, who want to come to Toronto to make their life here. We welcome them. We will continue to welcome them, and they will be to the great benefit of building up a strong economy and keeping the housing market, hopefully in a balanced state, not necessarily an overheated state.
What are the sectors you think will take the longest to recover when we come out of this, and what does worry you the most?
I think hospitality in the broadest sense, hotels, they're empty right now because nobody's coming to visit from anywhere. And I think it'll take time for people around the world to sort of get back into that habit of traveling. I mean, it won't be taking, the rest of the decade, but it will take time and it'll be very gradual. So I think those industries and people will have to have staying power. I think on the smaller scale, the kind of restaurant and that part of the hospitality industry, same thing. I mean, people will get their confidence back gradually about indoor dining and so on. So I think those are two of the ones that will take quite a long time. I think others will bounce back fairly quickly. Now, that's me as an optimist. I mean, I still talk to the people in our tech industry here, which, as I said, has grown hugely, tens of thousands of jobs over the last few years. Those smart people are out there. They haven't left town. Many of them have carried on with business. They're coming up with exciting ideas, some of them, in effect, driven by the pandemic and its realities that caused us to have to use technology for different things. So life sciences, I mean, the quest for a vaccine, among 1,000 other things, goes on. Financial services, we're always going to need people to help us raise money to pay for things and to help us with investments and so on. And so I'm an optimist. I think that Toronto has a unique combination of critical mass of industries, smart people, a huge commitment to post-secondary education, a welcoming environment in terms of embracing people of all faiths, colors, sexual orientations, whatnot. And I believe the immigration will pick up. I think if you look today, and again, I know there'll be some people out there listening to us who will challenge me. If you were sitting in London and New York and Toronto, or if you were applying for, asking for to hire someone in those three cities, and there's a smart candidate sitting in Germany saying, which one shall I go to? I like our chances. I think we could punch above our weight in terms of getting more than our fair share of those people to come because they watch how things are going, what the fundamentals are of the city, and how we've handled the pandemic.
I think that we should end on that positive note. And I want to thank you very much for your time, Mayor Tory. It was a pleasure speaking to you.
It's a pleasure for me, and I'm not paid to be an optimist. It's my job to be an optimist for the city, but I am genuinely optimistic, and I'm optimistic for the world. You got to have a sense of hope, and I hope people out there have a great sense of hope about whether everything we talked about, green bonds, social bonds, and what they stand for, smart people and how they're still smart even after a pandemic, and how that gives us a great foundation as a world, to build upon. And I like to think this is the best place in the world, but of course that is my job to say that, but I believe it in my heart. So thank you very much for having me on, and good luck to everybody in the conference.
Thank you very much. I'm going to hand things off now to my colleague, Kevin Orland, who is moderating the next session.
The opening bell has rung on the London Stock Exchange, and gold prices are already soaring.
Investors here in Germany are moving more towards safe haven assets.
And here in Canada, precious metal commodities are reacting. Let's take a closer look at how this will impact your portfolio.
Understand the world impact on the Canadian economy as BNN, Canada's business news network, joins forces with Bloomberg, the leader in global finance. The all-new BNN Bloomberg, local insights, global power.
Hi, my name is Kevin Orland, and I'm a Bloomberg reporter in Toronto. And joining me today is Alberta Premier Jason Kenney. Thank you for joining us, Premier.
Thank you. Sorry for being a bit late. I was just chairing a cabinet meeting.
No worries. So it's no surprise that the pandemic has been difficult on all levels of government, and that's certainly been the case in Alberta too. The province came into the year expecting about a $7 billion deficit, and that is now up to about $24 billion that's expected. I know balancing Alberta's budget has always been a top priority of yours, but how long now does it look like that will take, and what's your plan to get there?
Well, we've seen a 1/4 evaporation of revenues. So we're down about $12 billion on revenue on a $60 billion budget. Non-renewable resource revenues, they used to be $10 billion a year pre-2015. They've averaged $5 billion a year between 2015 and COVID, and now they're down to just over $1 billion a year. So our focus now is on getting our economy back to growth. Obviously, that's going to take some time. There is no way that we'll get back to fiscal balance without growth, which is why in June we launched what we call our Alberta Recovery Plan, which I think is actually very ambitious in its scale. It involves a $10 billion investment in infrastructure this year, which is without precedent, an acceleration of a reduction in the business tax rate, acceleration of our red tape reduction initiative, several sector strategies to speed up diversification of Alberta's economy in everything from petrochemicals to fintech. And so economic growth is the number one focus of our fiscal policy response. Secondly, we will have to continue with our spending restraint and find more efficient ways of delivering government. I've always said that's not difficult in Alberta. Well, it's never easy, but it's made less challenging by the fact that we have the least efficient government in Canada. On a per capita basis, we spend about 20% more than other provinces. So we'll have to address that, including through upcoming negotiations with public sector unions on compensation. In our February budget of next year, we will be presenting a framework to get back to balance. It's just not possible to do that in this term of government as we had initially hoped. But I do think that we can get back down to roughly where we were, which is like to say something in the range of a $6 or $7 billion deficit by 2023, and then we have a manageable number to work on in the next term of government. So some very difficult choices ahead for Albertans. But I think if we can get growth back and continued restraint on the spending side, we'll have a credible path to balance. We'll also be publishing what we call a fiscal anchor. That really is kind of like the parameter for that, the outer limit of our tolerance for debt. And at this point, we're thinking of a debt to GDP ratio of 25%.
All right. So you sort of alluded to this, but prior to the pandemic, your government convened an expert panel that looked at ways to balance Alberta's budget and get the province back to balance. And the top recommendations in that report, it was the McKinnon panel, were to sort of focus the efforts on cutting spending in healthcare and education. Now, how are those efforts going given the extra demands that the pandemic has placed on the healthcare and education systems?
Sure. Just a small nuance there. The McKinnon panel did not actually recommend cutting spending in those two areas because we ran on a platform commitment to maintain or increase spending in health and education, obviously in nominal terms. But they did point out that we should be able to find savings in our healthcare delivery and then reallocate those savings to address cost pressures through population growth and the aging of the population. So, in fact, our Minister of Health just this morning released the government's response to Alberta Health Services' proposal for implementing an Ernst & Young performance review on Alberta Health Services. I should say we spend about $21 billion a year on health. We spend about 20% more per capita than other provinces, and a lot of that is driven by public sector wages, salaries, and benefits. We spend about 20% more in wages, salaries, and benefits in the health system. Our physicians, for example, are the best compensated in Canada by a country mile, according to the Canadian Institutes for Health Information. Their gross billings are about $100,000 more than Ontario. So one thing that we are doing is we've instituted a cap on the total envelope for physician compensation at $5.4 billion. That's not been favorably received, but quite frankly, the physicians have been getting about 6% annual increases, and we simply cannot accept billions of dollars of additional compensation when they're already the best compensated in Canada. We also will be pursuing contracting out of ancillary services in the health system, such as laundry, food, and lab services. We ran on that in our platform. And so, as I say, our minister just tabled a more detailed response. You know what, we were initially hoping to be able to identify about $2 billion of efficiencies in health, every dime of which would be reallocated into the system to deal with cost pressures. So no absolute reduction in the budget, but obviously COVID hit. And so we've had to hit the pause button on a number of those changes. So I guess our scale of ambition in finding efficiency in the health system is more modest now in the COVID era for obvious reasons. We'll have, but we still will be able to find, I think, hundreds of millions of dollars of savings within the $20 billion budget to reallocate to cost pressures.
All right. Well, as the province is still working its way back to budget, back to balance, there's going to be a need for financing some of these deficits. Can you talk a little bit about how the province has gone about financing its spending this year so far with bond issuances, and what remains to be done? What markets are you looking in? Size of deals, those kind of things.
Sure. Well, I will say that, like many governments, we had some pretty tense moments in the first 3 weeks or so of COVID, and in March going into April, we were having real difficulty selling our bonds, but that was not, I think, unique to Alberta. That was just a reflection of credit markets getting frozen. Thankfully, since I think early mid-April, we've been able to sell our bonds and turn over our debt on pretty favorable terms. Obviously, when we're dealing with slightly over 2 points on most of our debt. So since the middle of March, we've issued about $22 billion in the bond market. About 60% was issued in the Canadian market and the balance overseas. And so we feel confident that the market will continue to be accessible to us. Obviously, we've seen bond rating agencies downgrade credit ratings for governments across the world. We expect to see that for Alberta as well. But in the long run, we would point out that we have the lowest net debt to GDP ratio, the lowest debt to GDP ratio of all of the Canadian provinces. So in that sense, thankfully, we do have some runway to deal with the crisis.
All right. Now, switching now to the province's energy industry, obviously oil prices have bounced back from negative territory, but they're still sort of languishing. Oil prices are still languishing around $40 a barrel, which is not a great price for Alberta's producers. We've seen a number of layoffs in the industry, about 2,000 coming from Suncor earlier this month. What's your government doing to help the province's energy industry?
We're doing everything we can. First of all, we help to put them in a more competitive position with the initial installment on our job creation tax cut, our reduction of the general business tax rate, which for many of those operators improved their balance sheets, which turned out to be, I think, helpful in this crisis. Secondly, we have been pushing hard on our red tape reduction initiative. We really believe that Alberta's energy sector had become, in some respects, uncompetitive because of the layering on of regulatory complexity in this province versus competing jurisdictions like those in the United States. Our goal is to become the fastest moving jurisdiction in North America with respect to approvals in the energy sector. Third, and we have a red tape reduction table with the energy industry in that respect. Thirdly, our investment in the Keystone XL pipeline with TC Energy is critically important because when global demand returns post-COVID, and we see, I believe, a projected shortage in supply because of such a scarcity of investment in E&P, we're going to see the price come back, but we'll need to be able to demonstrate to markets that we can get our product to global markets. That means pipelines. We're optimistic about the continued progress on Trans Mountain to the West Coast, but we weren't prepared to put all of our eggs in that basket, which is why we made a $1.5 billion preferred equity investment in Keystone XL. Construction is well underway on the Canadian side. I was just visiting one of the spreads in East Central Alberta last week, and it's crossed the border with Montana. There are pump stations and other infrastructure under construction down south of the border. That is critically important. As well, to help the service sector, we are delivering on the $1 billion well reclamation program being partly funded by the Government of Canada. On the gas side, we led an agreement between the mid and downstream players a year ago now for voluntary curtailment effectively during periods of service on the Nova gas transmission line of TC Energy. That helped to really increase the price from 30 cents to about $1.50. Gas prices are relatively good these days. We're optimistic about that. So those are some of the things that we are doing. We also, work with the federal government on getting the backstop in place from BDC and EDC for mid and small size cap companies. And we understand there were some complaints that those facilities really were not accessible. We've been working with the federal government to fine tune those programs, and we're hearing from the patch that more and more companies are accessing that credit backstop to get through this trough right now.
All right. Well, I'm glad you brought up the province's investment in Keystone XL. That's what my next question was going to be about. With Joe Biden leading in a lot of the polls in the U.S. and, in fact, having a widening lead, he has vowed to cancel that pipeline. How are you feeling about your investment in that, given that he has vowed to cancel it? What sort of leverage do you have to keep this project alive if he is elected?
So we made this investment knowing full well that there was some political risk south of the border, and that's why we did it, because we weren't prepared to sit here and allow others to determine our fate for us. We thought it was critically important that we de-risk the project politically for TC Energy, and that we, much like the federal government did with Trans Mountain, and secondly, that we create facts on the ground to which a different administration may have to respond. And the facts are this: that the construction is underway, the pipeline has crossed the border, construction on elements of the pipeline are well underway in the United States. We engaging important unions, building trades, LIUNA, and other large construction unions in the United States who are traditional supporters of the Democrat Party. We recently appointed a new senior representative to Washington, former Parliamentary Finance Committee Chairman James Girard. He is working with Canadian Ambassador to the United States, Kristen Hillman, and with our federal partners, as well as, of course, TC Energy, and like-minded actors in the United States to make the strongest possible case to a prospective Biden administration. And the case is essentially this, that even during a period of energy transition, the United States is going to need a safe, secure, reliable source of energy. The refinery complex on the US Gulf Coast is tuned for large feedstock of heavy oil. Either that comes from Alberta or it comes from the socialist dictatorship in Venezuela, an OPEC member. And I think, the argument makes itself. So we have a lot of allies in the Democratic Party, and if there is a change of administration in November, we would hope to engage the transition team both directly through those unions, through friends in the Democrat Party, and through the Government of Canada to make the case that canceling this project would really injure the most important U.S. trading relationship, that with Canada.
All right. Well, you also, in that answer, mentioned the energy transition. Right now, there's a big debate going on about the future path for oil demand. You've often cited an IEA study that says that even in a Paris-compliant world, the world will still need about 60 million barrels of oil a day. I understand the IEA came out with a new forecast today that has a little bit more pessimistic projections as far as oil demand. What do you think is the possibility that in a 60 million barrel a day world, Alberta barrels are included in those?
Well, to be clear, that's their most bearish scenario. So I don't know what the new IEA top line scenario is. It was 110 million barrels per day in 2040. OPEC came out last week with a 2035 projection of 107 million barrels per day. But quite frankly, whether it's 80, 90, 100, or 110, we're talking about a heck of a lot of hydrocarbon energy, which the world will be consuming 20 years from now and beyond. And so the notion that the world's going to flick a switch and suddenly airplanes will be flying on batteries and petrochemical plants are going to shut down, and that the developing world is going to stop its drive to get out of energy poverty, well, this is ridiculous. The reality is that in that world, surely the global energy companies with the highest ESG ranking should be the preferred suppliers. And guess what? Those are the Canadian companies. The challenge we've been dealing with here has been, when it comes to ESG and access to capital, has been primarily driven by a campaign from, disproportionately from European green left organizations that have sought to portray the Canadian oil sands as an asset class, as being equivalent to or virtually identical to thermal coal, which is unscientific and it's absurd. And so much of that gives zero credit to the Canadian oil sands operators for their massive investment in technology that has incredibly shrunk the carbon intensity of Alberta oil. We're down 30% from the beginning of this, from the year 2000, and on track for another 20 to 30% reduction in emissions intensity. We are below the global average emissions intensity for a barrel of heavy oil. And many of our producers have committed to net zero by 2050. Admittedly, it's an aspirational target. But you tell me, do you really think that's going to be the case for producers in Russia or Saudi Arabia, where they don't have any actual anything like our Canadian standards of transparency, of reporting, of oversight, of environmental regulation? And the other point we would make is, the world needs to stop focusing exclusively on the carbon issue and also look at the social and governance issues and the human rights and labor issues. Do we really want to hand a global monopoly to hydrocarbon energy in this period to some of the world's worst regimes who use those resources, those revenues, to spread instability around the world? I don't think that's good for the globe. It's not good for the environment. So I think we have a very strong value proposition, and our government is committed to communicating that more effectively, partly through the new Invest Alberta agency, which will be coordinating our ESG advocacy efforts with capital markets in Europe and around the world.
All right. And I'd like to get your thoughts on Canada's fiscal picture as a whole. In this pandemic, what programs that the federal government has rolled out do you think have worked? What have maybe missed the mark? And how would you like to see the country's finances managed going forward in this time?
Well, look, we understand that the government of Canada, like all governments around the world, have had to go deeply into deficit to cope with the crisis, both the collapse of revenues and extraordinary spending. And we appreciate much of that spending, and they've been generous with provincial governments in coping with the crisis. Having said that, I do think it's important for the federal government to take a step back and look at how we're going to get out of this. Let me come back to what I said about our province. I think this applies to the federal government in Canada. We are not going to be able to cope with this enormous debt burden that we're driving ourselves into without returning to growth. And I think that means a couple of things. First of all, it means during the COVID period, we need to impose the least possible damage and restrictions on the economy, while obviously ensuring that we protect. I always say we need to protect both lives and livelihoods. And so, I'll give you one example where that's relevant. We're encouraging the federal government to work with us on protocols that would allow us to facilitate safe travel, as many European countries have done. We're not going to get our economy back to anything like normal levels of growth unless and until we've returned confidence in travel. That's one example. Secondly, mid to long range, all governments, and I would say especially the Canadian federal government, need to return to a focus on economic growth, on productivity, on exports. The largest subsector of the Canadian economy, the largest Canadian export industry, is the oil and gas industry. $100 billion in exports, 500,000 jobs directly tied to it, another 300,000 jobs indirectly tied to it, 20% of Canadian government revenues generated from it. We cannot get back to pre-COVID levels of growth, let alone the kind of higher levels that we will need to deal with the COVID debt, unless we clear out obstacles to investment, to growth, and to exports, including natural resource and energy exports. So our plea to the government of Canada is, please do no harm. For example, please hit the pause button on the clean fuel standards. That could add $3 to $5 per barrel of oil, making our industry even less competitive. Please hit the pause button on Bill C-69 environmental reviews during this period. Please stop imposing the new plastics ban that could deter investment in the petrochemical industry in Canada. The legislative ratification of the United Nations Declaration on the Rights of Indigenous People that will move us from an obligation of consultation to one of getting consent. All of these create greater investor uncertainty at a time when we need to focus on economic growth. That's our message to the federal government.
All right. Thank you. And from your last question, we have about a minute left. What of all the changes that we've seen during the pandemic, whether they're social, political, economic, do you think will persist after the pandemic has subsided?
Well, the debt will certainly persist that we were just talking about for a long time to come. So I think, look, we will get through this public health crisis. What the great challenge of our generation will be how to pay for the trillions of dollars of spending that we're engaging in now, and across the world, the hundreds of billions here in Canada. And that's why I think one of the enduring legacies of this must be governments that are focused on a growth and productivity agenda to ensure that we don't end up going into decades of declining standard of living to pay for the taxes to manage the debt burden that's built up here.
All right. Well, that's all we have, all the time we have for today. Thank you for joining us, Premier.
Thanks again. Appreciate it.
All right. And thank you all for joining this fourth session of the Bloomberg Canadian Fixed Income Series. We hope you enjoyed these discussions. Thanks again to all of our speakers and moderators for a great program. And a huge thank you to our sponsor, National Bank of Canada, for making today's event possible. And most of all, thank you to you for being such an engaged audience. We look forward to having you on the upcoming sessions of the Bloomberg Canadian Fixed Income Series, which will continue for the week. At our next session, we'll continue to look at the public sector. We have an interview with Manitoba Finance Minister Scott Fielding on the program, and we plan to explore the topic of provincial borrowing with some deputy finance ministers from across the country. But we'll also talk about ESG and have a spotlight with two remarkable speakers from the World Bank. Tune in just 2 days on Thursday, October 15th at 11:30 a.m. Eastern Time. For more business and financial news from Bloomberg's global newsroom, visit bloomberg.com. And don't forget to follow Bloomberg on Twitter @business. Thank you very much for watching.